Well, welcome everyone. I hope you're all doing well. We're so glad that you joined us today to talk about financing the growth of your business. I'm Scott Wright with the North American Hardware and Paint Association, and I'm delighted to be joined by one of the industry's foremost subject matter experts on the topic, Brian Misenheimer from Live Oak Bank. Brian, welcome.
Thanks, Scott. It's great to be here to support NHPA and as a trusted industry lender. Scott, today's session should be a great conversation starter to help retailers who are contemplating financing to grow their business.
Yeah, it's a very timely topic, as we have witnessed unprecedented growth in our industry over the past 4 years. We've seen retailers of all sizes looking to grow by adding additional units, as well as improving their existing stores to make them more productive and offer a better customer experience. And today we're going to be focusing on what you need to know to make strategic decisions on obtaining the financing you need to grow. Now, one thing to note to everybody, we will have a dedicated Q&A session toward the end of the webinar. So please use the chat function to enter your questions, and we'll have Brian answer those in the order that they were received. So Brian, let's jump right in. I know you've worked closely with many retailers in our industry through the years to provide financing. Roughly, how many hardware stores have you worked with? And maybe talk about Live Oak Bank's expertise providing the service to our industry, especially as it pertains to SBA loans.
Sure thing, Scott. Personally, I've worked with hundreds of independent retailers, hardware store owners over the past 2+ decades. A little over 4 years ago, I joined Live Oak Bank. And while the bank is headquartered in Wilmington, North Carolina, we have a national lending footprint that includes SBA and conventional loan options, as well as treasury services. Not to mention, our business savings rates are about 8 times the national average for the shameless plug that I just gave you there. As a top SBA lender, we were #1 for many years, and by dollar volume, we make loans across various industries. And we actually have over 35 industry verticals that all have focused deal teams that lenders, underwriters, loan closers, construction managers, portfolio managers, et cetera, that fully understand what it takes to fund your business. No two SBA lenders are identical when it comes to SBA loans or even conventional loans. So having the industry background, we've structured loans #1 to meet the needs of the industry that we are focused on. In this case, independent retail hardware store owners, in my team, and we also structure loans to fully utilize the bandwidth of the SBA SOP program. So many other lenders, they might participate in the program, but they may not use the full bandwidth on the collateralization or the unsecured lending parameters. SBA, the 7(a) program is a cash flow based program, so we're cash flow based lenders. So that plus having not only the SBA platform, but also conventional and small loan platforms kind of differentiates us a little bit.
Okay, so let's take a quick look at the industry today and what we are seeing at the halfway point of 2025. At NHPA, we're constantly taking the pulse of retail performance, whether it's through our annual cost of doing business study or the quarterly retail index, where we gather performance stats and KPIs. We also get a lot of this information anecdotally from the many retailer roundtables we host, where members share their KPIs. So as you see on the screen here, this is what we're seeing today in a nutshell. We're seeing stagnant sales across the board, likely due to overall economic uncertainty. And this likely stems from things like tariffs and inflation. Many retailers are reporting that margins are up slightly, which is a bright spot in the face of rising prices. Retailers are also taking measures to improve their operations, whether through re-merchandising projects to add new product categories, or by investing in technology to make their operations more efficient and provide a better shopping experience. And finally, while there has been a bit of a lull in acquisitions compared to the past couple of years, many retailers are still looking for growth by adding units and expanding into new markets. Proof of this is how competitive the acquisition landscape is right now, according to almost everyone we talk to. So Brian, are you seeing this as well? And can you comment on some of the common growth challenges that you see hardware retailers facing today, such as the perception of high interest rates?
Yeah, absolutely. Retailers have had a lot thrown at them over the last 5 years now. And wow, can you believe it's been 5 years since the spring of 2020 when COVID hit us? As essential businesses, COVID boosted sales, profitability in the retail industry, and increased market share for newfound customers during the period, right? Many folks took advantage of either also exiting their business or buying these essential businesses that became more, appealing to own, moving from one industry to the next and going into the independent retail hardware industry. With some of the lowest rates in history helped drive this acquisition, behind it. Now, while the acquisitions seem to have slowed slightly in the recent term, with anticipation of rate cuts, the silver tsunami is still kind of a thing. So fully anticipate acquisitions to continue on going forward. And I think that the fact of the matter is, you look at this primary history chart that we have here, this next slide here, dates back to the 60s. And if you notice, there's little gray columns on there. The gray columns represent historical events that have occurred in the economy. The last two of which, as you can see, in early 2020 with COVID, and then prior to that in late 2027 or 27 in 2008 with the Great Recession. Prime was at a all-time low due to those economic issues that were going on. Fed cut rates down to 3.25. So that was a great time for a low rate environment. People got used to it, and things started going well with inflationary economy that we've had. In 2022, the Fed started rate increases. First increase is 2018. Rate hikes directly response to the rise in inflation levels. And if you look at back, it's inflation levels not seen since the 80s. So that said, if you look at the rates on this chart compared to the 80s, high teens and 20s range, versus the post-COVID prime rate only being as high as 8.5% in July of 2023, and today at a 7.5% at prime rate with no change since December 19th of 24. It's 7.5 doesn't look too bad right now for a base rate of prime. So regardless of the rate, where the rates are at today and potential rate cuts or staying at 7.5%, retailers and small business owners cannot sit on the sidelines to time the market. So reinvestment in your business is the key, not only to growth, but also staying relevant in light of the competition that you're facing these days, from online sales to other brands or concepts entering your market area.
Now, Brian, I've heard you use the term strategic financing. What exactly do you mean by this, and why is it important for hardware retailers to know what this entails?
Yeah. Well, I always say structure and deal terms beat rate every day of the week. So an example, you got $1 million term loan. You got a 10-year loan at 9.25, or you got a 5-year loan at 6.25. Which one's better? And the answer is it depends. So cash flow, do you prefer to pay $12,800 a month or $19,450 a month? Which one do you prefer? That's a 60, savings of $6,600 a month or $79,000 a year. So what could you do with $79,000 a year difference in cash flow in your business? Answer is you can sock it away for a rainy day. You can use that money to accumulate for that next project, or just bolster your liquidity position for future events that might happen down the road. SBA versus conventional, again, strategic financing. Utilizing the SBA program, it's more borrower friendly, longer terms, less out-of-pocket costs, and not dictated on collateral to size the loan. So doesn't require financial ratio covenants. Conventional loan structures are typically just the total opposite of that. We don't have the lender doesn't have a government guarantee in place, a credit enhancement. So we're not inclined to go as aggressive. We want to see some skin in the game, more skin in the game, and to reduce risk and get return of the capital back, which is equally important as return on the capital, if you will. So that said, not all lenders are equal when it comes to loan structures either. I mean, their credit boxes vary from lender to lender. Again, working with a lender that understands your business is super important. Number one, number two, if you're working with an SBA lender, to make sure that they're a preferred lender. So you're not going through two sets of underwriting. You're actually working with a lender that can fully embrace the SBA's SOP and understands, what unsecured credit is. Because oftentimes it is, even though we're taking liens on inventory and business assets, they don't really provide much in the terms of actual collateral value in your business. So those are the key points I would focus on there.
Okay. At NHPA, like I mentioned earlier, we're all about measuring success through KPIs and the benchmarking tools that we offer, such as our cost of doing business study. What are some of the KPI improvements that you see when retailers utilize strategic financing to foster their growth?
Yeah, sure. All of the above. I mean, funds are used to expand the business, purchase equipment, technology for improved efficiencies, and both can improve profit and cash flow. So, you should get some sort of return on your investment for whatever you're doing to the business, right? So that's kind of a given. Also by utilizing the correct financing structure, you can take advantage of improved cash flow, and excess cash flow to continue to grow your business. So making sure again you have the right structure in place will result in improved cash flow and affordability of that new product or equipment that you want to purchase. Even if you're not using funds to expand today or grow today, you might think about consider looking at your current debt structure and making sure those things are financed appropriately. Uh, Doing a debt refinance, a consolidation loan can free up your cash flow in your business and allow you to build up some liquidity and some savings for that rainy day, or to be used towards the next project, or equity capital for the next acquisition even.
On this slide, we see a comparison of the SBA 7A loans versus conventional. Brian, can you take us through this and discuss the key differences between the two, maybe noting some of the advantages and disadvantages of each regarding things like terms, rates, requirements, that sort of thing?
Sure. So conventional loan parameters, conventional loans are generally speaking are shorter termed. The amortizations they usually have balloon payments involved with them on a term loan basis anyway. Down payment requirements are a little more than what is typical for an SBA loan. So you're getting longer terms, more flexible terms, no balloon payments with the SBA loans because they're under the 7A program. They are fully amortized over the life of the loan. So you don't have to come back and ask for a refinance or a maturity of in 5 years having to go back and on a real estate deal having to go back and get another appraisal and environmental and have another closing. It's these loans are kind of set and forget it mindset. So it allows you to really focus on your business and not worry about so much on the debt maturing and all the financial ratio covenants that are associated with that. Pay your bills as agreed to continue to do well and set it and forget it and move on.
So what's the maximum loan amount a hardware retailer can borrow, and what are the guarantee percentages required?
Right. So two different topics on guarantee. So the SBA guarantees the bank's debt, not you. So it's a credit enhancement for the lender, not the borrower. But it entices the lender to go on beyond with the terms and the lower down payment opportunities, because we do have that 75% government guarantee. The max loan amount is $5 million, but you can take a reduced guarantee, or you can some lenders will be willing to do a little larger loans, or do a pari passu loan like ourselves, where we'll go into a side-by-side conventional loan that looks in all the terms and conditions are exactly the same as a 7A loan, but it goes over an extra couple $1 million to allow for business acquisitions and commercial real estate purchases that are too large for the 7A program, but we still find value in the multi-purpose loan program that allows you to combine real estate and business debt and go for the longer amortization, the 25 years if it's 51% real estate. And as far as guarantees go, your personal guarantee is required typically on both. there's not too many conventional lenders doing non-recourse these days, but in the case of SBA, we're going to want to see anyone with a 20% or more ownership interest in the business guarantee the debt. And, some people say, well, what if you got 10 owners? Well, 10 owners at 10%, somebody still has to personally guarantee. It has to be a warm body behind the deal. There's also some other new parameters in place too on eligibility, but we won't get into all that today. But again, working with a preferred lender that understands the SOP and the new eligibility requirements is super important when you're looking at an SBA type transaction. We also have Live Oak Express, kind of another differentiator that allows us to do smaller loans. So generally speaking, the typical lender is out there doing loans from 350, 500,000 on up. And there's a big gap in the market for these smaller loans, 10,000 to 350. So we like them all. We have a program specifically for them as well.
Okay, I know there are many reasons why retailers obtain financing for growth and business improvement, and you were kind enough to pull together several case studies to illustrate some of these scenarios. Can you take us through them, starting with one of the most common, which is the transfer of ownership from one generation to the next?
Sure thing. So in this case, second generation, operating, growing up in the business, went off to college, came back and started working the business again. Ended up started buying into the business over a long-term plan that was put in place with succession planning in mind. That son bought his dad and his uncle out when he came to the bank for 100% change of ownership to allow them to go off and retire. As a young person in the retail market with some college tuition debt in place, didn't have a lot of cash or additional down payment requirement, but he had earned in up to 20% of ownership. And that's not a hard and fast rule. The percentage of ownership doesn't really matter so much, but being on the tax return for the last 2 years did. It allowed him to come in with zero money down. We provided a 10-year loan for the change of ownership. He already had equity, so we were able to utilize that eligibility requirement for no down payment under the SBA SOP. The other part of the puzzle was he wanted to do some new things to the store that dad and uncle didn't want to be part of, so allowed him to renovate the store a little bit with some a new POS system and a store refresh that helped with some capital on that front. So that was a positive. And these deals take time to get done. A deal like this, I would say 60 to 90 days or 45 to 60 days. If it had real estate, I would extend it on to 60 to 90 days. And we'll go through another example here and we'll talk about that as well. But under Live Oak Express, it's days versus weeks versus months to get those deals done here at the bank.
Well, yeah, let's go on to the second case study. And this is one of the most common examples of growth that we have seen in the past several years, especially, and that's adding more stores. So can you take us through this?
Yeah, this gentleman and his wife, second generation owners, had 3 stores, had the opportunity to fall on his lap of a 2-store chain for sale. Both had real estate, which was very fortunate, but it made the deal size much larger than what the SBA 7(a) loan program was geared for. So again, working with Live Oak because of our appetite to do the pari passu conventional loan structure and kind of overclock the guarantee, if you will, but get a larger exposure out there in loan. We were able to provide that for acquisition financing for this gentleman and his wife. Had minimal down payment to accomplish this, and we were able to get that structure put together and put the whole deal on a 25-year transaction. So business and real estate, because real estate was 51% of the use of proceeds, we were able to do one single 25-year loan. One plus the conventional loan mirrored. So making 2 loan payments to the bank for both business and real estate for the multi-purpose acquisition.
And over the last several years, especially, I've spoken with many owners who are upgrading their existing POS systems, maybe enhancing the merchandising in their store. And this last case study illustrates that. Can you take us through this one?
Sure. This is a Live Oak Express opportunity under the Express program. You know, the 7A program does have an Express program, but Live Oak Express has both SBA and conventional. 10,000 to 350 per borrower is what will go. Under the 7A Express program, our program, we're not financing any real estate though. So that allows us to be truly express as the words that are in the title of the program. So we're able to do these deals in days or weeks versus months, unsecured effectively. We'll take a lien on business assets or a junior position in this case, but allow the borrower to put in a new POS system and some upgrades of fixtures and signage to kind of refresh the store and get on a new platform to be able to manage inventory and increase efficiencies. Again, help with the longer amortization because it's a 10-year loan and versus the 5 to 7 you might find on a conventional, technology lease program. So it was very helpful.
I'm sure a question on everyone's mind is the evaluation process and exactly what criteria you use to determine eligibility for obtaining a loan. Can you take us through your process for this and what to look for?
Absolutely. Well, the 5 C's of credit is if you talk to any banker and or any bankers online listening to this, the 5 C's of credit is nothing new or specific to any one lender. It's kind of how we're credit trained to evaluate our borrowers. We look at character, which is the most important, cash flow, which is the most important, capital, which is most important, collateral, also most important, and conditions. So they're all equally important, but really the truth of the matter is cash flow is king. Character is who you're going to be in the relationship with. So just as you're looking for the right bank to work with, we're looking for the right borrower. So good past credit history. We're not trying to finance a whole bunch of criminals. And if you have experience in education, we want to make sure that you have that behind you. Cash flow is obvious. If your existing business, does it cash flow the debt? If you're buying a business, does the existing business that you're buying, does it service the debt that you're going to put on it for acquisition? If not, then maybe you're paying too much or you're not putting enough money down. Yes, we will do projections-based lending in certain circumstances. And yes, we do look at global cash flow. So we're looking at your outside income for cash flow. And pretty much all lenders look at this very much the same way. We're looking at, how are we going to get repaid? Cash flow king. Secondly, do you have skin in the game? Capital, how much have you put in? Is there seller financing involved? If you're a member of a cooperative wholesaler, there's incentives and C-stock loans, either vendor sponsored or loan programs that the wholesalers have available to them. Obviously, city, county, and state incentives are there for facade, block grant improvement loans, and those kind of things. The key to that is making sure that everybody that's providing capital into the deal are all on the same page of what the collateral position is. And that leads us to collateral. We're as a senior lender, we're going to look at banks or senior debt. We're looking at first UCC and all business assets. First lien on real estate, we're financing the real estate. Seconds on personal residence if we have collateral shortfalls to help mitigate risk. Those are all things that need to be taken into consideration when we're lending. Under the SBA 7A program, it's a cash flow based program, but if it's available, we must take it. So first lien on business assets secured by the real estate we're financing. And then if we still have a shortfall, we're looking to you personally and maybe some life insurance to boot. So those are all things that we're lending against. And obviously the conditions, micro and macro, we understand the industry on a macro basis, the economy on a macro basis. Micro is what your market look like. What's your competition look like? What does your business plan look like? Or do you have your ducks in a row for feasibility of, is this going to help this financing package we're putting together? Is it going to help, with a positive outcome to put this debt on your business? So we're looking at all those things together. And there's a 6C too, Scott, that I look at. I guess it's part of character really, but it's confidence. And if say you've got an applicant that they has hired someone to do a business plan, local college, they provide some help with business students to do business plans for local businesses or score or some projections. But if my borrower doesn't understand the projections and the business plan, what's in the contents of that, I've got to make sure they're confident they can execute to that plan. It's not just, hey, I got somebody to do this plan for me here. I'm checking a box. We want to make sure it's an actual plan. It's kind of like a living, breathing document too. So that confidence is really what's going to carry through your deal through underwriting. You're showing good character, and then the rest of the stuff falls in place.
Brian, what kind of information do retailers need to pull together to start the loan application process?
Yep, it's for the loan application, and not only for applicants, but if you're trying to, some people on the phone might be or watching this webinar might be thinking about even exiting their business or what they need to do to get someone else to buy their business. This kind of applies is the same as true. We're going to look at 3 years of business tax returns. We're underwriting on that personal financial statement of the guarantors to figure out what their capital is to invest in the deal and their post injection liquidity looks like, their background, their resume, and their bio, interim financial statements on the business, and business debt schedule, and a little bit of understanding about the history of the business and the competition and market that they're in. But ultimately, we're looking at this information to test cash flow. So again, you can test your own cash flow by doing some analysis on your own statements and seeing if can your business support a new owner salary or comp or return on investment plus the debt load that you're trying to put on it with the sale price. But all the transactional information, business plan, projections, letter of intent, purchase agreement. So it's really transactional information, the information on the business you're either financing or buying, and the people behind it, just to get that list together. And this is pretty typical information you're going to have to provide to any bank. So having that package together and a well-organized package is super important as well. If you're making a scan from hard copies and every scan page is a separate PDF, it makes it difficult for transactions to get processed quickly and efficiently. And pages get slipped or missed, and it could leave out some great detail. So working with your accountant or bookkeeper or just internally preparing this information in advance of approaching a lender is super important. They might have some separate forms for you to fill out on their own letterhead, but at the end of the day, this information will get you pretty far along the way for a request for financing package.
Hey, Brian, with the time we have remaining, we would like to pose some questions to you from our audience members. And again, if anyone has a question that they would like to ask Brian, please post it to the chat. So here I'll call on my colleague, Austin. Austin, do we have any questions posed from the chat?
There are no questions in the chat right now, Scott. Again, yeah, we encourage you guys to ask questions in the chat, but for now, maybe we could proceed with some of those questions that we received ahead of time, Scott.
Yeah, here are a few to get us started, Brian. So question number one is, what are the most common reasons loan applications get rejected, and how can we avoid these pitfalls?
Yep. So back to that slide I was showing you, we're talking about earlier about all the information that you need to collect ahead of time is having the financials available. If you've got financials that are a year or two old from a business that you're trying to purchase, or you haven't completed your 24 financials yet, or don't even have 25 interim financial statements yet, that's not enough information for a lender to advocate, to underwrite, to advocate to credit for any kind of loan approval. So getting on top of your financial reporting is number one. The other thing is there's a lot of going through the financials and making sure that whatever you're earning, we can document any kind of bona fide add backs, seller discretionary earnings or expenses that are not normal, extraordinary expenses. Say you just did a remodel on a store and you paid cash for it, but you expensed everything. Those are bona fide expenses that are one-time extraordinary that will and can affect cash flow and might get your deal rejected. So having a list of all these extraordinary things up front, having your financial statements in a very well organized manner, and then tying those financial statements to tax returns for SBA, especially for SBA lending, is super important to make sure that we can document and substantiate these bona fide add backs expenses, if you will, and everything tracks to be able to test cash flow.
Okay, a second question is what's the minimum credit score and time being in business typically required for owners applying for SBA loans versus your Live Oak Express loans?
Yeah, many lenders are, every lender is a little different, but we prefer to be in the 700s. I think we can still get comfortable in the low to mid 600s. You need to have a story behind why your credit might be down in less than the 700 range. Any kind of slow page, we need to have a well articulated explanation of why. Bankruptcies are a very hard pause for many lenders, and depending on the reasons, there are some reasons that we folks can get comfortable with it, but it's a hard pause for many lenders. So I think it's high sixes, mid to mid sevens is where we target our borrowers to be. Otherwise, need a really good explanation of why the credit score is low. And back to that, another reason why the loans get declined is because there's a question on most loan applications. Have you ever filed bankruptcy? And if you say no, because a lot of people think, well, ever means last 10 years or 12 years that falls off, whatever. But the word ever is ever. So if you say no and we do a check, some lenders do, some lenders don't. But if we check and find out that you did in fact file, then we're gonna pretty much kick that out of the credit queue, because it's kind of a character issue, not being upfront about it. So just be a clean slate when you're presenting yourself to your lender. Show them the skeletons in the closet, if you will, and highlight the positives as well to mitigate those risks and help us get you there.
Okay, a third question. For seasonal hardware businesses with fluctuating cash flow, how should we present our financials to best position it for approval?
Right. So back to that list again, the last year in plus the most recent interim. Well, if we're here today and you got first quarter numbers available, if you don't have through June, then you show me your first quarter numbers and they look down. If I annualize the numbers compared to year end, first quarter is the worst quarter, right, in hardware industry. So typically, generally speaking, so we need to see a seasonally adjusted number. So if you can either print a trailing 12 months or provide a same period prior year comparative of the prior year, say first quarter to first quarter, then we're good. Generally speaking, lenders are going to want to see loan financials no older than 60 days old at time of application anyway. So again, if you're not on top of your financials, you absolutely should get on top of them. And for seasonality purposes, just make sure we have the prior year same period available. And as we all know in the hardware industry, seasonality, the weather, the number of days or weekends in the month, all kind of have an effect on numbers depending on what time of the year you're looking at those P&Ls and balance sheets. So make sure you articulate any things that are different that you know about your business from period to period, comparative period to comparative period, to help your lender get through it. We need to know that not just the numbers, but the story behind the numbers too. And you know that better than anybody does.
Another question, how does the loan process differ when buying an existing store versus financing an expansion of my current location?
Well, existing operations, we need equity injection for sure. Existing operations don't always have to support the expansion. We can lend on projections for that. You can also lend on projections for an acquisition, but the acquisitions most certainly should cash flow the debt that's being proposed for the acquisition portion of the loan, because you're going to have acquisition and you're going to have some upfit, some improvements, some other things that might be quasi projections or pro forma basis. So absolutely, we want to make sure that the historical cash flow supports the debt that you're incurring. The leverage you're putting on that business works with add backs that still are discretionary. And again, going back through, and if the current owner that you're buying from is taking out, say, a couple $100,000 a year, and they're paying uncles and cousins and everybody else that in the business that's not actively working in the business, we're going to need to do a deep dive and have schedule those discretionary add backs and substantiate them with W-2s, payroll reports, expense reports, etc. That can help us get behind that to use that as cash flow add back on a pro forma basis to support your pro forma. So it's a little different, but not. It's pretty much a lot of the same information.
Okay. Austin, any questions in the chat yet?
Brian, we did get one question. An attendee is wanting to know, what are the current interest rates on SBA loans?
Right. So prime is 7.5, as we were talking about earlier in that historical prime rate chart. It's been there since December 19th of 2024. Prime's been 7.5%. You just look at the rate forecast back then to now. We're supposed to be down now. They've not cut rates yet, so crystal balls are all broken from that perspective. But you know the spread over prime, the max the SBA lender can charge is prime plus 3. So it's all lender based. It's all risk based type capital type transactions. But generally speaking, anywhere from a prime plus 1 deal all the way to prime plus 3. Depending on the loan size also dictates. The express loans that are smaller, unsecured capital, they're a little riskier transactions, underwritten a little quicker. And sometimes those are, in the prime plus 2, 2.5 range. But it all depends on every deal. Every deal is different. There's some competitive rates out there, fixed and floating. I mean, the floating, most people these days, from what I'm seeing in the market, is they're going with a quarterly adjustable or semi-annual adjustable, or no more than annual adjustable, at least, because there's hope and thoughts that the rates are going to come down, or even stay the same, but with the opportunity coming down. And to that point, on 10-year loans under SBA, there's no prepayment penalty. Loans of 15-year amortization or terms or longer, there's a 5%, 3%, 1% prepayment penalty in the first 3 years, respectively. And after that, there's nothing. So after 3 years, there's no prepayment penalties on those longer term SBA loans anyway. So, yeah.
Brian, working with hardware retailers as long as you have, and as long as I've been in this industry, which is 30 plus years, you know that no two retailers are the same and their situations aren't the same. So do you have any examples of how Live Oak Bank structured a loan that had very unique challenges or circumstances?
Well, I mean, that Para Pursue is a very unique opportunity for sure to utilize a multi-purpose 7A loan and conventional structure together to be able to achieve the $5 million SBA max, a multi-purpose loan for business acquisition, working capital, all closing costs, etc., packed into that deal to gain a 25-year AM, and create a cash flow monster, basically, to allow that store to accumulate a lot of excess cash flow over the last 2 years. Additionally, knowing the ins and outs of the SBA SOP is pretty important. Understanding what you can and can't do, and making sure that you take full advantage of affiliation rules, and having a lender that fully understands it is key. There's scenarios where father and sons own a business together, and the sons go off to do their own business, and this business has SBA runway because of the ownership structure, and this business also has SBA runway also because of the ownership structure. So understanding that affiliation rule and how to best parlay that was key in those transactions.
Okay, last call for questions. Austin, has anyone submitted?
No other questions at this time.
Okay, well, I know as soon as this webinar concludes, there will be a lot of questions from our audience members that they didn't maybe feel comfortable asking. And so on this slide, we see an abundance of resources that Brian has pulled together to help answer the most common questions about a lot of the topics we discussed. And I would please note that all audience members today will get a copy of this presentation. We'll email it to you with these links so you can continue learning about strategic financing through Live Oak Bank. And also a recording of this presentation will be available on NHPA's website. You know, I also want to mention that Live Oak Bank has been such a great partner with NHPA's retail marketplace. And this is where folks can list their businesses or stores that are for sale and be connected to retailers who are looking to buy stores in our industry. So please check this out at yournhpa.org/marketplace or by emailing marketplace@yournhpa.org. In addition, Brian is going to be leading a workshop on this topic at the upcoming Independent Home Improvement Conference in Orlando. So this will be on July 30th and July 31st. So if you haven't done so already, please register to attend the conference and Live Oak Bank's breakout sessions here in just a couple of weeks. So, Brian, I want to thank you so much for being with us today and sharing this information. We really appreciate that we have a resource who specializes in our industry. Brian's information is listed here on the screen, so you can contact him if you have any additional questions or if you're ready to start financing the growth of your operation. So thanks again, everyone, and have a great day.
Thanks, Scott. I appreciate everyone who joined, and don't hesitate to give me a call, follow-up questions. I'm here to help.
Thank you, Brian.
Take care.